This is Marc Chaikin, founder and CEO of Chaikin Analytics. I see that people are still streaming in. We had a great day on the market, so I think nobody wants to leave the ticker tape. We're going to begin the webinar in about 60 seconds, so stay with us, and I'm going to introduce our guest webinar presenters. Okay, if everybody's ready to roll, let's start the webinar. As I said, this is Marc Chaikin from Chaikin Analytics, and many of you know the deep respect I have for Bob Lang and explosive options. Bob also has the respect of Jim Cramer and does his off-the-charts technical segment once a month. Bob was kind enough to introduce us to Jim at a party at Jim's restaurant just 2 weeks ago in Brooklyn. And there we got to meet the real brains behind the explosive options and credit spread trader success, Suze Smith. And Suze has been a successful portfolio manager and private trader, got to options late in her career, and has really done a great job of not only getting up to speed, but becoming so proficient that she mentors traders for explosive options and also generates very profitable ideas through the credit spread trader. And she's going to be talking about credit spreads today. Bob Lang presented about credit spreads last December to the Chaikin audience, got a really positive response. And Suze really generates the ideas that come at you on a daily basis as they come up on her radar screen. So it gives me great pleasure to introduce both my friend Bob Lang and my new friend Suze Smith. So take it away, guys.
Great, thank you very much, Marc. Well, happy Thursday to everyone. I want to welcome all of you to our webinar today, and again, thank you for the again, Marc, for the warm welcome, and it's an honor to be presenting to the Chaikin Analytics community today, and I'm excited to bring all of you to the forefront of some of the best and most profitable trading strategies you will find out there. I think if I would ask you all a question about whether this is a tough or an easy market, I'm sure most of you would probably raise your hand and say yes, it's an extremely tough and difficult market. It's challenging every single day. We're faced with different obstacles to deal with, whether it's something in the news or some maybe some we dropped a bomb or something's happening in Washington or whatever. It creates a lot of volatility, and volatility is created from uncertainty. But one thing that is certain is that the success of our credit spread strategies, which is the explosive options spread trader, is quite good. And we'll be talking about that a little bit later, but I'm going to go ahead and move forward. First of all, a couple of things to let you know. If you have a little trouble, here's a disclosure here. If you have a little trouble listening to the webinar, something's not clear, the audio is not working, you probably just want to step out of the webinar and come right back in, and it should work fine for you. I have hit the record button, so the full session is going to be recorded, and it will be up on the website a little bit later on this afternoon. So if you can't stay for the whole session, which we hope you will, there's going to be some good question and answer later on, and I believe Suze is going to be sharing some of her charts and probably showing you how she sets up a spread trade that she does regularly, just as an example, but it's just a good little primer on how she does things. You'll be able to have an opportunity to see that. That's probably going to be towards the end of the webinar session. So again, here's a disclosure here. A little bit about me. Marc went into a little bit of a small bit of detail, but here's a little bit more. I'm the founder and chief options strategist at Explosive Options. I run a service of my own. Suze has her service. We both joined together about almost 4 years ago and put together one of the most invigorating and lifeblood of our service, which is the chat room. And a lot of you guys who are in our webinar today know what we're talking about. Some of you, I recognize some of the names in here, like Tina and Stephen and Patty are all in our webinar, or I'm sorry, in our chat room every single day. Formerly, I was a portfolio manager for hedge funds and pensions and the 401k for Sunkist Growers out in Sherman Oaks for about 4 years. I ran a $200 million pension, and by the time I was done, it was about $320 million. I was basically the asset manager over there. I'm a frequent contributor, as some of you know, for TheStreet.com Real Money and Options Profits, which is now turned into Real Money Pro. Some of you may know that I help Jim Cramer feature my charts regularly on the Mad Money, CNBC's Mad Money, the Off the Charts segment. We did those last week, and Suze actually did her charts yesterday for Jim. Did a great job with the semiconductor stocks. I'm co-manager with Christopher Seiss for Trifecta Stocks. And if you were going to nail me on what my expertise is, and I don't really figure I'm an expert on really anything at all, but if you had to say it, it was probably more about technical analysis and the psychology of trading. So a little bit about Suze. She manages a multi-million-dollar client funds for Strategic Portfolio Solutions out of Addison, Texas. She's also co-founder of Explosive Options with me, the chat and the spread trader, and she manages this service directly. She's a Real Money contributor, writes articles for Real Money and puts them out there for everyone to read. And as I said earlier, she provides some content and good charting technique for Jim Cramer's Mad Money Off the Charts segment. She has moderated a forum for Dan Fitzpatrick at Stock Market Mentor and optionmarketmentor.com, and she was a former paid contributor to writing articles, which is very difficult to get paid on unless you're getting a lot of page views, for Seeking Alpha and the originator of the MTS blog. So here's a little bit of what we're going to learn today. Get your pencils and pens out and your paper out and write some notes today. We will give you a chance to see these slides, but still, learning is about paying attention, watching, listening what's going on, and then writing things down. So what are credit spreads? Why we use them? And Suze has an incredible method about creating a consistent stream of income. And she'll talk about this term called laddering. And I think we probably have about 5 or 6 slides that talk about ladders. So I suspect if you don't know what a ladder is, other than a ladder to go up the side of a building, we know what a ladder looks like. If you don't know what ladders are as it relates to credit spreads, by the end of the session, I believe you're going to be really familiar with what that means. Risk levels and different spread types and how we utilize credit spread strategies. And there's different kinds of strategies you can do with iron condors and verticals. And then how do we get the most from our services? We'll be sharing that with you towards the end. So before I turn it over to Suze, I want to share a little bit about the results. And performance is something that we take a great deal of pride in. Right. I've had some great success with my service, which I started back in 2011. It's been almost 6 years. Some years not so good. Other years just lights out fantastic. Right. But we can see here, we started this service September 28th, 2016. And we put it together after having a discussion, trying to figure out how we can utilize her brain and what she does and what she knows for the past several years. And we came up with this idea about, well, let's just create credit spreads and send them on out to people. And sure enough, last year her performance was lights out fantastic, almost 12%. You can see that right here, 11.95%. Basically the last 3 months of the year. So let's call it the fourth quarter. Started September 28th, so through the end of December 2016, 12%. But so far this year, and this is through last Thursday, 21.5%. So you throw that on top of that, that's an amazing, impressive number of about 33% in slightly over 6 months. I defy any of you to find a service out there that can put generate these kind of numbers, these kind of returns. And when you compare that to what the S&P 500 has done through last Thursday, listen, it's a very impressive 4%. But compare that to where Suze's results are at 21%, and it's 5 times more than what the S&P 500 has done. If you want to throw in a more riskier bogey, I mean, her strategies are low risk, high probability. If you want to throw in another strategy, comparison, another bogey, the NASDAQ is up about 6-7%. The Russell is not quite up as much. You get the point. All right, this is where it's at right now. So without further ado, I'm going to go ahead and hand it on over to Suze, and she's going to talk about what are credit spreads. And I'm happy to my partner, my best friend over here, to send it on over to her. And are you with us?
I'm here.
Okay, Suze, I'm gonna hand you over the make you the presenter right now. We'll be able to see your screen in just a second.
Okay. All right, let me get on the proper. Okay. We all here? What are credit spreads?
So say hello to everybody, and it's all yours.
So hello to everybody, and thank you so much for joining us today and taking a little bit of your time and sharing it with us. I hope that everybody will find what we are presenting informative and be able to take it home and use what you learn here to make money and grow your portfolio. One thing that I would like to point out with the spread trader portfolio and with the returns, this is an actual cash funded portfolio. These are trades that are actually placed and made. So these are actually we have skin in the game. And that has a lot to do, or I tell you that because that has a lot to do with the type of risk that I put on, and why I pay so much attention to what's going on, and it has a lot to do with why we've been able to be as successful as we have been in doing these credit spreads. Credit spreads. As we know, options are designed to be wasting assets. So they're designed to go to zero. 80% of all directional options go to zero. We flip that around, make time decay our friend and our asset. That means 80% of the time, things should go our way and we should be able to have a successful trade. That's just right off the bat. So we sell premium rather than buy premium. We take in a credit. Options are a zero-sum game. You can either take the buyer side or the seller side. So you can sell puts or bull put spreads, or sell calls or bear call spreads. Take in a credit. With credit spreads, you are offered a predetermined return or a reward for a predetermined risk over a predetermined and established period of time. That's extremely important, because you know what you're going to get paid potentially on a certain date by a certain time, as long as the option selections that you have chosen stay within a certain range. They don't go above here, they don't go below here, and you get to keep everything that you took in. Some keys to success as far as options go are to hold your spread open as long as possible. Sellers of options have the time decay working for them. That's where I said that the time decay is your friend. When you are going directional on options, every single day the clock is ticking, tick, 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 and the value of your option is decaying. When you flip it around and you're taking in that premium, that's actually to your benefit. Every single day that goes by is another point in your favor. So the more days that go by that it either stays range bound or actually rises if you're doing a bull put spread, or falls if you're doing a bear call spread, the quicker your spread is going to max out in value, and you can potentially close it early. You should have a plan where you want to take off the trade at a specific point. Oftentimes we will just try and get the meat of the bone, get 80% of whatever the spread is. Sometimes if it's a shorter term, we'll go for 50%. If it's something extremely volatile, we'll go for 50%. But most times we go 80%. If you can get a spread closed 2 weeks ahead of time for a dime, get 90% of that trade, close it out, free up your margin, put in another trade, and you rinse and repeat. So that's something that you should have some sort of an idea of when you want to take off the trade, or take off a portion of the trade. If you go in large with a trade, if you do say a 10 lot contract, you can take off half of it and then roll what you just took in the premium into something that pays a little bit higher, and leave the rest to expire worthless. Something good to do is to wait for a really good moment, extreme volatility, to enter your trade. You can find a lot of volatility during the day if you listen to the news, follow Trump tweets, anything, pretty much anything. You can find some sort of a volatility spike during the day that you can enter into a bear call spread or a bull put spread or some type of credit spread, where you will get extra premium just for having waited to find that precise moment in time to put that trade on. You can put it on any time, but you might get extra premium if you just wait for that specific moment in time. And I can't think of a day, at least lately, that hasn't happened. Have you seen that at all, Bob, that we haven't had some sort of extreme volatility during the day?
No, there have been some, like today, there was some news in the other direction, right? Usually that extreme volatility takes place when some, like, the mother of all bombs hits, right? And that happened last week. Wasn't it last Thursday? When the markets were up nice, and then all of a sudden it's almost like, you're in an airplane, all of a sudden you start running out of gas and the airplane starts falling on you, right? And that's what happened to the markets last week, and even earlier in the week, same deal. But yeah, no, there's always some opportunities. You keep your eyes open, pay attention to what's happening with market volatility, and you use those to your advantage, which is what you've been doing.
Exactly. And speaking of that, of the market volatility, everything that we trade has a volatility indicator. There is a volatility indicator for whatever instrument you're trading. We have been specializing in trading the indexes, the Russell 2000 or the RUT or the SPX. We use the VIX for the SPX. We use the RVX as the volatility indicator for the RUT. So those are two important indicators that we pay attention to, and we'll look at them a little bit more in depth here in just a few minutes. Also, picking the right strike selection and the expiration date combination, those are extremely important items that you have to get right off the bat. You don't want to be too close in to where the action is. You want to be above deviations. And in doing that, I'm going to go ahead and switch screens right now. Give me a second to switch screens, and I'm going to show you what you should be seeing here on stockcharts.com is a chart of the RVX. Is that what everybody sees? Yes?
Yep, I see it.
Okay, so the RVX is the volatility of the Russell 2000. This trades inversely to the rut. So I've made little notations here. You can see that I have on double sets of Bollinger Bands. So I have second and third standard deviation Bollinger Bands. You can see way back here from November, we've done nothing but trade in a range. We trade in a range. So when the market, or when the RVX is down here, that's when we sell our bear call spreads. When it's at the top, it generally doesn't make it through its top Bollinger Bands. This does not like to go out of deviation. That's when we sell our bull put spreads. When the RVX is elevated, that means that the market is down. The Russell 2000 is down when the RVX is up. Vice versa, when the RVX is down, then the market is up. So we get more premium when we sell bear call spreads down here and we sell bull put spreads up here. You can see right here, we tripped it at 2092. That is deviation through the Bollinger Band, and we immediately came back in. We came to test this 200-day moving average. Today it came up to test the 8, and it's going to come back down to once again try and test this 200. And you can see that on the MACD, this is rolling over or stair-stepping down, as is the stochastic. So this would indicate to me that we actually have some further market upside on that. So that's how we monitor the volatility of the rut and how I know whether I want to be selling bear call spreads or bull put spreads on the rut. Also, when we're doing this, you don't have to, we like to play both sides of the market. We like to do the bear call spreads and the bull put spreads. So we might start off with doing the bull put spread of things first. And then as the market corrects itself and it rises up, then we'll sell the bear call spreads, and that creates an iron condor. So we're receiving a total bigger credit, which gives you a higher return on your money, because if you do, let's say in our portfolio, we do 10 lots. If you do a 10 lot and it's a 20-point spread, it requires $20,000 worth of buying power. You're able to put the top on, the matching top. If it's the same 20-point spread, you're able to put that on for no additional margin. So if you're getting, as a for instance, $2 for your bull put spread, when it comes, when the Russell goes up and you can get $2 for your bear call spread, you're collecting a total of $4 on your $20,000 margin, and it greatly increases your returns. So that's something to keep in mind, is to try and play both sides of the market there. Now, the reason that we have been concentrating, let me put that back on the rut real quick. The reason that we have been focusing on the rut, and you can see how long this has been in consolidation. Okay, now we're going to go back over here to the RVX chart here. Takes a second to load it up. Notice that these ranges, 16 to 20, 16 to 20, 16 to 20, 16 to 20, 15 to 20. The volatility on the rut has been trending sideways for such a long time, but it has a greater range. It's not as narrow as the volatility on the VIX, which is what the SPX goes on. See, this is tiny. This is 10 to 14, 10 to 12. It's much narrower. You use the same concept. This trades, the VIX trades inversely to the SPX. So you would buy your premium down here. You would sell your premium up here. But the SPX volatility range is extremely narrow and lower, so we've been focusing on the RUT because we get more bang for our buck. Does that make sense to everybody?
Yeah. So basically, if you can see the range in the VIX, you can see by and large, I mean, just generalizing, it's from about 10 on the low side to about 12.5, 13 on the upside, right? And
correct.
So
it's $3 versus $6 on the RVX.
Right. And then when you throw another concept in there about realized volatility of the market is extremely low. It's even lower. What you're looking at is implied volatility. Realized volatility is even lower. So that tells you that even if you're selling at the money premium for something within a couple of days, you're really getting nothing, zippo on any premium selling. So even if you go out a couple of weeks, 2-3 weeks, and the VIX is only, we close at 14% today, which is rather high from what we've been used to for the past 3-4 months. Still, you're not getting a lot of premium, and we figure that if you're going to take risk, if you're going to take some risk, and even if this is a low risk of high probability structure that we're putting together here, we still want to get paid, right? We always still want to have something attractive there. And and if you're going to get something attractive, you've got to lift up the price, the spread to be closer to where the price is. And as you do that, you're taking on more risk. And so
more risk, right?
So what do we want to do?
And our strategy is to lessen the risk by using instruments that have a higher degree of volatility, so you get paid more for the risk that you're taking on, but we're still staying well with it, well away from the actual price. So with the VIX, where we're only getting 14, here we're getting 18 on the RVX. So that's why the RUT trades are paying better than the SPX trades. I'm going to switch this back over to our screen here, or to our slideshow. The important relationship with the VIX, volatility generally has the inverse relationship with the markets. When the VIX is up, options premiums, they're getting expensive or they're expanding. When they're expanding, we're wanting to sell. When the VIX is coming down, they are becoming cheap, as market expectations for, the expectations are for smaller market moves, and you can't get very much premium when the VIX is low. When the VIX, the old saying is, when the VIX is low, it's time to go, and when the VIX is high, it's time to buy. That's the saying that I always keep in my head. So when you have a low VIX, it's very difficult to get premium at all. Why do you want to be an option seller? You want to be an option seller because you can predefine your risk, you can predefine your time, and you can put that time decay on your side. You can design trades that theoretically, going into the trade, have a 90% probability of being a successful trade before you even enter into it. That's a really important, that's huge, and I don't know of any other way that you can enter into a trade having those sort of odds in your favor. I just don't, I don't know of any other way to do that. When you want to sell premium at extreme sentiment levels, when too many people get on one side of the boat, you want to take the other side. You automatically want to take the other side. If you're looking at a candle and you see a great big long wick fall, starting on the bottom or starting at the top, and especially if it's at a band, and especially if it's at a deviation band, if it goes into the third standard deviation, that's when I'm looking to sell premium. I'm looking to sell it right then, right there. That's when you're going to get the most bang for your buck. So you're going to get the most premium when you're doing something different from everybody else. If everybody and their brother is betting that the S&P is going to go to zero, you're going to want to take the other side of that trade. 90% of the time, you're going to be right on that. So, oops. Here is the RVX again. You can see each time that this RVX has touched the upper Bollinger Band, this is just one standard deviation. It's reversed. It's been a reliable pattern. Pattern following in technical analysis is extremely important. So we consistently sell bull put spreads here. Every time it comes down and touches the bottom, here's one of those candles where everybody got out of whack. If you sold bull put spreads down here, which we did on the right, you got more premium for them. You also got more premium for them there. A reliable pattern you can follow. That's when you want to sell your premium. The Russell 2K, the rut, has been ideal. We discussed that due to the premiums being richer, due to the volatility being better. It's been in a very consistent range, trading within a certain band parameter. The Russell 2000 is not an extremely volatile index. It doesn't fly up and down like the Nasdaq or the SPX. It has a lot of large holdings. It's very diversified, so there's not one single super large holding like IBM hits the Dow. That's not going to happen in the Russell 2000. Since inception, the EOS spread trader has made how many rut trades, Bob?
I want to say it's 13 or 16, and I think only 2 of them were.
So 14 out of 16. We've made 16 rut trades, or a combination of rut trades and iron condors, but I think we count just each one as one. We bailed out of 2 of them for risk management purposes. It's always important to know where you're at. Hindsight being 2020, those trades would have worked out, but that's not the important thing. The important thing is there was a risk parameter that was set. It was set in stone as to where it was set at, and I adhered to my policy in calling off the trade.
So for those who are scratching their head right now and wondering, well, what risk parameters are you talking about? So Suze looks for trades. If everybody's familiar with the term of delta, we're not going to go into the Greeks today. We may have maybe mention it 1 or 2 other times during the slides, but we're not going to go into a description. That's for another day. But if some of you are familiar with the term delta, she's looking for a delta of about 10 to 14%. And simply put, what a delta is it's interpreted 2 different ways, but the one way I'm going to interpret it is it's the percentage chance of finishing that cycle, the option cycle, whenever prior to expiration, in the money, since she's selling them out of the money, right? So if she's selling a delta spread that's about 12, it's a 12% chance that price is going to hit the short strike before the expiration. Does everybody understand that? So that's the risk level. So if you want to say it's about terms of odds, it's an 88% chance of in that particular case, it's an 88% chance of winning. And if you want to put that over a ratio, that is a 7 times more chance of winning than losing on that particular trade. 700% chance of winning over losing. And that's just taking 88 divided by 12, and you get a ratio of 7 times. But as far as risk parameters are concerned, that's the comfort zone that we're in. Go ahead.
Correct. And so We do both bear, bull put spreads and bear call spreads. We do them independently and we do them together. It just all depends on what's going on in the world. Sometimes we don't get enough premium to put a top on to make it a condor. Sometimes we do. Again, the record is 16 wins, 2 losses on the rut. That's for this year. The trade added 12% to the overall performance. The delta on the trades was 12%. The probability on the wins of these trades was 88%. Most of these credit spreads did expire worthless. And my average holding time, and this is for all of my trades, my average holding time is only 1 to 3 weeks. So it's very short term. What you're doing is you're making money very quickly, rinsing and repeating. When volatility increases, then your spreads, the marks on the spreads increase. So these can
I think you want to say basically the extreme volatility sometimes will play with your mind and create a situation where, I mean, we don't know what to do. We've been in those situations before, so it's not always easy where when things are going your way and you wake up in the morning, you're up 7 handles and you finish up 20 handles like we did today. And when you're in your short put spreads and you're saying woohoo, we saw that coming.
Right. Well, just as a good example, we have a spread on now that's an iron condor. We're way down at on the put side of it. We're down at the 1295, 1275 for the bull put spread. We're at the 1410, 1430 for the bear call spread. Okay. We still are at very, very good probabilities on this trade expiring worthless. We sold this at $3.65, but it's currently marked at $4.25. That's because the volatility on the call side of it is expanding. So the marks within your brokerage of what you see, they're just flip-flopping around. So it actually means nothing. They're just numbers that are moving. As long as you are not at your short strike by the expiry, that trade is going to be 100% winner. So, sometimes the volatility around, we've had some big macro issues. We have some more coming up, the French elections and things like that. It does create uncertainty. So we do try and exploit that volatility, because once the volatility is removed, then things get back to normal. Then, the VIX and the RVX, they start trending back down. Then the iron condors, the bull put spreads, bear call spreads, they just start melting down very, very quickly. It says, here with the VIX around 16, that's ideal for selling premium on stocks in the market. That is a really, really good number to start selling. And if you see it at 16 and you see it continue to rise, or it looks like it's still going to uptrend a little bit, just start taking on your position in thirds. You don't have to put on an entire position at one time. You can leg in, do it in halves, do it in thirds, do it in quarters, however you need to do it. Just make sure that you are knowing what your intended total position size is, and that is it is appropriate for your total portfolio, that you're not exceeding, you're not putting your entire portfolio into credit spreads. About 20 to 30% of your portfolio should be dedicated to doing this strategy, and the rest of it should be dedicated to another strategy.
So I was going to mention, I've had so many stories. I'm not going to get into one of them right now, but one slide that I always like to put out there when I'm doing my webinars, Susan, for everybody, is that Anybody can have the greatest system in the world, black box system. They back tested it. They've done it for years. They said there's no possible way they can lose money. Listen, you go back. I know Mark knows the story of long-term capital back in 1990. 98, the most brilliant minds were, they said they couldn't lose money. They generated such amazing returns for their clients for years, and everybody thought that they were a genius. They were just printing money. Well, I've come across people who are just the same way, right? And they decided to just go all in, not sizing properly, and all of a sudden something happens and blows them up, and all of a sudden, boom, there goes their account. And because they didn't, something happened, something happened there. We all know Murphy's law, right? If the worst thing can happen, it can happen. So Suze, is absolutely right. You got to size correctly, as long as you know exactly what you can afford to lose.
And the Suze way of trading a portfolio is using the credit spread strategy to generate a consistent income stream. I take the profits from the credit spreads and I use them to buy high quality dividend stocks. So I'm using my profits to buy those stocks, and then I turn around and I sell calls against those stocks. So I'm building a well diversified portfolio, and I'm funding it off my profits from my credit spreads. It's a really, really good way to get a well-balanced portfolio, and it's making your portfolio buy your stocks, not your trading capital. So you're not using as much of your trading capital to just go out there and buy stocks. Use your profits from your credit spreads.
I know you hate this analogy here, but if people in the casino and a gamble, it's like playing with the house's money. Right. That's I know you hate the gambling analogy here, but it's really important point. It's a really important analogy here that, you're being able to play with the house's money, being able to keep your own money back in your pocket and using those profits to, as you say, get into other stocks that you would want to get into. So.
Right, and I actually not only do that, but after I reach a certain point, I just flat out take money off the table, move it into a separate holding account, and invest it into short-term bonds, 1 to 3 year, paying somewhere around 3 or 4%, and let them set, hold until maturity. That way, my trading capital does not become, my profits does not return into trading capital. I keep the things totally separate. Back into the webinar here.
So, real quickly, Suze, because there was somebody has a question. Lawrence has a question for you. That's kind of apropos to what you were just talking about a moment ago. Lawrence says, I notice that you often use a 20 or more point spread, where he says that most teachers trade a 5-point difference. I haven't really heard anybody preaching that versus the other, but he says, can you comment on the difference in your thoughts on this please? I would guess it's probably a risk.
Compare the premiums that you get for a 20-point spread than you get for a 5-point spread. I can do fewer of the 20-point spreads and get a better credit for a premium than have to do. Let's say I'm taking in $2 for a 20-point spread, and I can only take in 50 cents for a 5-point spread. I can do 10 of one, but I'd have to do 30 of another to make it even.
So the narrower spread is smaller, but you're going to have to increase the risk level, the market risk level, the market volatility level, in order to.
Correct. Yes, you're increasing your market risk, but you have to put on more of those in order to equal what you're putting on using the wider spreads.
Got it.
You just won't get the same premium.
Got it. Perfect.
Back on delta, low delta does equal high probability. the lower the delta, the better the chance of 100% success. The key is to continue to hold it and let the position work in your favor. Do not worry about day-to-day wiggles. Day-to-day wiggles do not make a difference in this world. You can set your position. You can look at it in the morning to see what it's doing. You can look at it in the afternoon to see what it's doing. Then you can close your eyes and go happily to sleep at night, unless something blows up. Bear call spreads.
I'm only
Some
sleeping
don't believe.
I'm only sleeping at night when I take an Ambien, but that's just me.
Some people don't believe bearish type trades make money in this market. We do it. We do it regularly. I love it. I am not bearish. I am opportunistic. Selling a bear call spread does not mean that you're a bearish. It simply means that you're saying that this stock is not going to be above this certain price at this certain time at this certain date, and you're taking on a credit in for that. There's nothing bearish about it whatsoever, and as long as the short strikes are far enough away from the current price, you have an extremely viable trade.
I have a good question for you, Suze. Maybe you can throw this out. This could be a good time to answer that. So let's say you're in a bear call spread and the trend is up. We're up today, obviously, pretty good, almost 1%. And let's say we're up tomorrow and now we're pushing up towards your short strike. We haven't pushed through it yet, but it looks like, you know what, with about a week or 2 weeks to go, there's a good chance of doing that. What would your next step be?
My next step would be to roll that up. I would actually roll up the bear call spread to a higher strike for the same expiry.
So that just gives you more space, not necessarily more time, but just gives you more room for that trade to work for you.
That's correct.
Okay, I got it.
That's correct. And you can usually, if you time it right, and I take care of that for anybody who's involved in spread trader, you can usually do that for a credit, for an increased credit than you originally took in. So that, that's something, it's a very, what we do in spread trader, it's very tactical, hands-on management. We're assessing it. I'm assessing it. Bob's assessing it. We're assessing it together every day, doing the work, so you don't have to do it. All you have to do is follow a very given set of instructions. Buy this, sell this, buy this, sell this, adjust this. Here's how you do it. It's just very, very simple. On to the next one, bear call spreads. This was just an example of a trade that we did Friday, March 17th. This is the type of alert that you would get. This one would come to your phone. This is an SMS. It's one of the services that we offer. You get an email, and then you can elect to receive SMSs as well. So on this particular time, we sold to open that April 13th, 1440, 1460 bear call spread. So we sold the 1440s and we bought the 1460s for a credit, and I try and give a range because it does take about 7 minutes from the time I find the trade for me to get it out to you, between $1.50 and $1.60. And then it gives you the legs, sell to open, tells you what to do. The 1440 call, buy to open, the April 13th, 1460 call, and what the current price was at the time that I put it out there, what the current price was. So it was actually 162 was the midpoint. I get that off of my institutional brokerage. So I came up with 150 to 160. And I believe we're actually filled at 160. The closing trade for that came in the same SMS. We made the majority of the money on the trade, entering orders to close the 413, 1440, 1460 bear call spread for 10 cents. I'm doing this to free up margin for additional trades. So we made 90% of the money on that. We actually closed it down at 10 cents, made 90% of the money, and went on to put 2 additional April April trades on. So there's no point in keeping your money tied up for 2 or 3 weeks. If you've already eaten most of the meat off the bone, there's no point in keeping the bone in the fridge. The dog's not worth it. Take your money and put it back to work someplace else. Now I just want to take a second, and I want to show my other screen again, and I want to show you what I'm looking at. When I go to find, and this is the rut, my focus is on this 200-day moving average and these Bollinger Bands. I want to be as close to or underneath this 200-day moving average. I want to be as far away from this as I can get and still get paid decent money. Okay, it's very important. Trades that I have on right now are down in this area. For the ones that I just put on, down around 1295, which is right underneath here, the 200-day. See right here where it held the 200-day? This 200-day is trending upwards. I do not believe that the rut is going to correct down and break the 200-day moving average. Therefore, I'm using that as my support, and I will continue to sell underneath the 200-day moving average. Those are my monthly trades that I put on. So my process is to first find a monthly trade underneath the 200-day moving average, and then exploit the weekly options by coming up just a little closer, but always staying outside of these bands. Always staying outside of these bands. So you're not going to find me selling a bull put spread up in here. I will never do that. That's not my style at all. That gives you too much risk. So would I do a 1320? Yeah. Would I do a 1300? Yeah. Would I do a 1280? Yeah, absolutely. On the upside, you look at your third standard deviation there. It's currently 1397.48. I'm a little close in right now with my 1410s, but we sold those when they were way down here. At the current time, I would be looking more at the 1430 to 1450 to do a bear call spread. But I won't do that until we get up here into this deviation state. That's when I will look to put that on. So I am way out of the money. When this is trading, we closed at 1384, and I'm looking for trades that are down, in the 1280 range. I'm, looking to be, at least 65 to 100 points out of the money, and that's both on the SPX and the RUT. I'm looking for the safe trade. I'm looking to be the person that is walking in front of a steamroller, picking up the dollars that nobody else wants, and the steamroller is running out of gas, and it's just, barely moving along, and I'm scooping up these dollars. And I'm just doing it over and over and over again, and putting them into my little pile until I have enough to buy a nice stock. It's a really, really good way to keep an income stream going. You have something coming and going every single week. Right now we have expiries for the 17th, the 28th, the 5th. Those are on the ruts. On the SPX, we also have things going out on May 3rd. So we're interspersing and diversifying our portfolio within the indexes. And then we also have some stocks, some of the more expensive stocks, price lines, price lines, Amazon's, Google's, we do bull put spreads on them, Regeneron, things like that we can also take premium that we're far enough out of the money by a certain percentage point, that we're not going to get hit. I look at this and I say to myself, what is the chance that this is going to correct from here to here? What is that percentage, and what are the probabilities that it is going to correct that much by my time period, be it 1 to 3 weeks? And then I set my trades accordingly as far as that goes. As an example, and this is one that just actually closed today. On March 31st, we sold an iron condor. The April 17th, we sold the 1310 1290 bull put spread and the 1430 1450 bear call spread. We legged into it, so they were two separate trades, but it did create an iron condor. We took in a total credit of $2.35. This was on the right. Now this was a monthly, so it actually ceased trading today after the close. So as of tomorrow, it'll be totally worthless. It actually went zero bid today, so it doesn't trade after today. On this trade, this was an actual 12% real return on this money, and the money was only involved in the market for 15 trading days. That's 100% return, or excuse me, 100% of the premium that we get to keep for 15 trading days. We do it in 10 lots, so that's $2,350 that we made in 15 trading days. We keep 100% of it, rinse and repeat. Keep going on, keep going on, keep going on. Bob, that's to you.
Okay. I'm up. Okay, let me get my slides here, bring it over to me. Okay. All right. So let's see where we're at here. Everybody see my screen? Which number slide are we on there, Suze? Or do you want to take
20.
it back? Number 20?
20. I'm sorry.
Okay. You want me to pick it up, or you want to go?
Bring it. I'll keep it. Bring it back.
Okay. Okay. There you go.
Got my screen. Share my screen. Sorry about that, guys. In our analysis here, we never even came close to the short strike. We did get a phenomenal return for the trade that we were in. This one, you know, was a very, very well paying. When we send out our alerts, we do it with a range so you get filled. And just in case, you know, you're away from your desk or whatever, you can't get in, you know, right at that precise moment in time, you know, a dime or so is not going to make a difference. You're going to get a fair execution and a fair price. If you don't know whether to pull the trigger on a trade alert that I've sent out, my email's there. All you have to do is pop me a note and I will immediately answer you and tell you whether to take the trade or not take the trade or how to adjust the trade. We'll set up good till cancel orders to buy back the spread, often under domicile. We've talked about that to free up the buying power for future trades. By doing so, that's how we're able to ladder the trades for different expiries. I go down through and look at on my options montage screen. It has every single expiry that's listed. In my book, I like to see that I have something expiring for each and every expiry, whether that be a Monday, Wednesday, Friday, or however, you know, whatever I can do to keep that going. I like to see that there's some sort of a position working for each one of those. And if I don't have something there, then I'll go back and I'll look for something there. You know, sometimes there's just not enough premium to do anything, but that's how we ladder our trades. We'll go first the monthly. You know, for this month it was, you know, the 17th, and then, you know, we came with the 28th. You know, we did some earliers for the 7th and the 14th. We did some for the 5th. We did some for the 11th. We're just, you know, in any place that I can find premium, I'm the premium. I'm the premium queen. I will take it. If you will give it to me, I will take it. Trying not to get stuck by some surprise event that causes a major loss to your portfolio. So we never want to hold on to anything too long. If we can get most of it, we'll take it and go on. If it's not working, we'll figure out why it's not working and either make a decision, pull the plug, roll it up, decide to keep it working if it's just a temporary situation, or create a new trade, because in options, what? We always have options. Go ahead, Bob. What do you have?
Well, what I was going to say is that back to that previous slide about plugging, pull and plug early. Slide number 21 there. What basically she's talking about is, you know, if it's not working or if it is working, it's about taking risk off the table, and that's okay. You could take a little bit of risk off the table, move on to the next trade, because especially as you said earlier, you know, when the meat's off the bone, you don't, there's not much left there. Why not just go out and buy another bone and with some more meat on it? That's
it makes the soup taste so much better. It just does. It just does. So I'm actually going to flip you over again up here. This is let me go here. And this is what I try and do. You see, I have the 21st, the 28th, the 5th. I'll be looking at the 12th, the 19th, the 26th. You just keep going down these. Okay, so let's open up the 12th and let's see what we have going on for the 12th. So we're trading at 1384 right now. So I'm going to go down my options montage here. And I always start with the bear call side. So we're going to look and see somewhere around the 1295, okay? And we're going to sell, and we're going to sell a vertical, and we're going to just automatically do it at 20 points. Okay, that gives us $1.17. $1.17 is not a whole lot of premium for a 20-point spread, okay? That means that I'm going to want to look upwards in price. Now, keeping in mind, I am underneath the 200-day moving average there. Okay, so we're going to fool around with this a little bit here, and let's look at the 1310, and we'll go that over. Let's see, 1310, 1300. And see, that's still not very good. $1.20 for the 12th. That's still not very good. So I'll pass on that. And we're just still playing around. 1300. Now I'm sitting right on top of it. Okay, so the 1320 over 1300, whereas our long put would be sitting, you know, right about where the 200-day moving average is. That gives us $1.90. That's an appropriate credit for that spread. So that is something that I would be interested in for May 12th.
So with 3 weeks, roughly 3 weeks to go in that trade. May 12th is a Friday, so 3 Fridays from tomorrow. I mean, that's a really good credit for a 20-point spread. You're getting $2, and if you show them the chart, Suze, where 1320 is, because that's really the concern is where's the short strike is. Where's that 1320? I mean, we're 65 handles out of the current price right now. So what is that? It's about 5%. You know, I mean, so what is the chance of the Russell dropping 5%? Probably.
So that's your first question, and
right.
And before I go off the screen, I'm just going to tell you. Let's just talk about this in a one contract thing. So this is a 20-point spread. It will cost you $2,000 in margin. For that, you will receive $190 in premium. $190 in premium on $2,000 will give you a 10% return on that investment in your 3-week, you know, trading time by May 12th. So that's the first thing. Now let's go and see where we're actually at on the, where'd my chart go? On the chart, we're right here. 1300, we're selling right here. We're outside of these Bollinger Bands, okay? And your long strike is there. So I do not believe we are going to break the 200-day moving average. And I do not believe that we're going to fall outside of these. The last low was 1335, and we are still below that.
Right.
So we're selling that 1320, so we're still not even anywhere close.
So everybody look at that. Pay attention to that. It's really important, because 1320 would be the short strike. That's the one you want to decay the most, right? Because we're short that strike.
Correct.
It's below the low of the year on the Russell 2000. Below the low of the year. It's actually 1% below. The low is 1335, which was in March, which we hit last month. And 1320 is 13 handles or 15 handles below that. So more than 1% below. We hadn't been to that level since you see that breakout in December, early December, over the left-hand side of the chart. And that was, after a pullback after a vicious rally post-election in November. So high probability trade. And again, you're playing a game of pickle here, and you have a great lead. People are if you remember the game of pickle when you were a kid, you have a lot of room to catch your base from one.
So what is the chance that it is going to fall from here to here by May 12th, and more importantly, break that when we have an uptrending or a MACD that's going on a buy signal? This is the rut, and we have a stochastic that is on a buy signal. The answer is slim to none. I would put the odds on that. Do I have delta on here, Bob? What's the delta on that?
Yeah, it's over on the right-hand column over there, but open that up a little bit more. I could find it as well too. I think the delta was probably something about 15 or something, as I saw.
So the 1300 is the 1320 is a negative 17, and the 1300 is a negative 12.
So you just net that out. It's actually 5. So so your delta is 5.
My delta is 5 to make a 10% return in 3 weeks. Mm-hmm. Okay, that is an extremely high probability trade.
95% chance of winning.
95% chance of winning just walking in the door. But then let's sweeten it up. Okay, so then we're going to wait a few days for this to play itself out, and we're going to go over here on the call side, and we're going to be looking at the bear call side of it, so we can condor it up, and we're going to sell a vertical, and we're going to keep it in the same 20-point range. Okay, so assuming we've already collected our $1.90 there, we're going to collect another $2.07 for the bear call side of things. That will actually be more like $3 when we actually get to where we're going. So we'll be collecting on average $3.90 on $20,000, or $3. We'll do it on one contract. So $3.90 on 2,000. That's 19.5% return on your money to condor that up in 3 weeks' time. And then again, it is an extremely high probability trade. Your delta on that is 15.
Actually, Susan, it's actually 15. It's actually 85%, so 15%. So what I did is I netted. Some people look at it as netting the total spread. In reality, all we really care about is the short strike. So so that's a 15 delta, and then the other one was a 13 delta, or a 17 delta. Sorry, so it was an 83% chance. So still on the short put spread, 83% chance of winning, and this one 85.
Correct. I mean, who would not want to? Does it make sense? I mean, we are way up here. We are way up here, and we are way down here. I'm staying far away from the money, and we're taking an extremely good premium. And we're going to do it week after week after week after week after week. High probability trades, duplicate them over and over again, ladder them up so that you have something expiring every week, every other week, maybe twice a week, whatever your income base is. You know, for people that can only, you know, afford to trade 1 or 2 lots, do one, you know, do a 1 lot for 1 week, do a, you know, 1 lot for the next time, do another one just twice a month is a nice, you know, is good enough to do a 2% month income stream with low risk.
So Suze, let me spice it up for everybody who's listening right now.
Get spicy.
Since you just said that you have a trade and a condor that expires tomorrow, it actually stopped trading today, expires tomorrow, right?
Yes.
What will you be doing tomorrow?
Tomorrow I will be putting on the bull put spread that I just described for May 12th.
Or something new, right? It might be something else. Might be something else. Michael Rosen says we're going to party tomorrow. That's true. But
Michael, we party every day. We have a really good time in our chat service. We love everybody in chat. We are a very tangible group. Everybody brings something to chat every single day. We show up for work. We love doing what we're doing. We love being there. Everybody brings something and gives something great.
But because these are expiring, you're gonna be looking to replace the one that expired with a new trade.
Absolutely. My money keeps churning and it keeps working. I work my money harder than it has a right to be worked.
Just giving everybody the fair warning, because if they don't jump on today, which we're going to talk about that a little bit later on, they're going to miss an opportunity to get on your on your trade, possibly for tomorrow.
This was an SPX that we did, 2125 over 2100. I did this with 9 days till expiration.
Put your slides on.
Let me, my bad. There?
Yep, that's it.
Okay, this is a trade that I did on the SPX, 9 days till expiration. This was one of those things where I exploited an intraday volatility. I did do a 25-point spread. There were only 9 days to go. It was 9 calendar days, not 9 trading days. These were nine calendar days. So for $1.40, so the actual trading days was less. Even though we only got $1.40, that was a 5.6% absolute return on risk over those 9 days, and it grew your portfolio 1.4%. That was based on $100,000. That's an actual trade that we did. We did a 2230, 2250 bear call spread for $1.30. That one was 16 days till expiration. That was a 6% absolute return over 16 days. See how we're laddering these out? You know, one was 9 days, one was 16 days. We collected $1,300 total for that trade. That was over $100,000 portfolio. And for a $100,000 portfolio, we trade 10 contracts. I believe we get into sizing a little bit later on down. Just those 2 trades in 1 month, one bullish, one bearish, you gain 2.7%. If you know the SPX stayed within the 2125 and 2230, you know, you can annualize that out. You can duplicate it. I've been duplicating it consistently. Well, I did it all last year, but I started doing it in size. I tested it out in the beginning of last year, in 2016, but started really putting on size starting in March, and then really started putting on size in August. And the clients became very happy campers. My mom was one of my clients, and she was extremely happy. So laddering it up is definitely the way to go. And then, of course, using your profits responsibly, taking them off the table, and buying something that's good.
Sue, so let me ask you about laddering just for a minute, about your psychology, because you do put on quite a few trades. Does it help you sleep better at night by knowing that you don't have all that risk of trades expiring just on one day, or does it really matter at all?
Well, for me, I sleep good at night for two reasons. Using this strategy. Number one, I'm able to have an idea to plan. I have a plan for a return. I can make a plan in my mind of what a return can be in my own account. So by laddering trades, I can say, okay, I got $1,000 on this one, 1,600 on this one, 4,500 on this one, 2,600 on this one. So at the end of the month, this is how much should be added to my account if it all works out. Okay, that helps me sleep well at night. Okay, and trading in the indexes, knowing that somebody's not going to come out and say my company's too overvalued, or we have an accounting issue, or an SEC problem, or business was soft, or I don't have to worry about any of that with the indexes. All I have to worry about is a major global event. I don't have to worry about earnings risks. At least trading the RUT and the SPX. I don't do anything with the Dow for that reason. Just those are the main two reasons, is that I can make a plan to generate some income. And I know some people that do this that have been able to take things off of their bucket list. They've been able to plan for purchases and actually make their goals and pay for what they needed to pay for because they stuck to their rules. They put on their trades. They took them off when they were supposed to. They put the money aside, and then they had the money to, buy what they needed to buy. It's a good way to trade. It's a simple way to trade as far as that goes. And there's lots of different ways, to trade, spreads. You can do the vertical spreads. You can do the iron condors, which is the bear call spread and the bull put spread together. You can sell naked options. We never sell naked calls because they have unlimited risk. So never sell naked call ever. We do cash-backed puts, but not in our service. You can sell deep out of the money spreads. You can do deep in the money puts as a stock substitute. You can sell diagonals with long leaps. Lots of different strategies that we can bring to the table. And the spread trader service, we focus solely on the credit spreads and do those in the iron condors. Index option trades, we analyze all opportunities and all the vehicles with, as long as it has good liquidity and multiple expiries. We focus on the RUT and the SPX, but we also do things, the Priceline, the Amazon, NVIDIA, Google, Sherwin-Williams, anything that has good premium, good liquidity, and that's going to make a move for me, or trade sideways, as long as it has a range that I can trade within, that I can identify with, and that is not going to have an earnings event within my time frame, I'll trade it. Not a problem at all with trading that. Credit spreads instead of futures. Futures do not have any time decay. You can't trade futures in an IRA. Futures don't have a limited risk profile at all. You can lose your butt in a heartbeat. futures are better used for hedging, and we're after an income strategy. Options, we're taking advantage of that time premium, which the futures don't have. So we're actually using the leverage of the options to capture that time decay, and we're exploiting the delta. Selling credit spreads is far less risky as the time decays in your favor. If you sell more time, you may get more premium, but your risk profile does increase the further out you sell. So don't try and sell something 6 months out and get $6 for it, because a lot of things can happen between now and 6 months. Okay, let's try and stick 1 to 3 weeks. We can control 1 to 3 weeks and kind of forecast out or have an idea of what may happen in 1 to 3 weeks. The ideal credit spread for our purposes lasts about 2 to 3 weeks. That should actually read 1 to 3 weeks. We get them when we can. Again, we often use intraday volatility to establish shorter term trades. Delta. We try and get the lowest delta we can when selling our bull put spreads. That a delta is the amount a option will move with $1 move in the underlying price of the stock. So if you have a delta of 1 and you have an $86 stock, if the stock moves $1, then theoretically your option should move $1 as well. And the lower the delta, the lower probability of reaching the strike. So if you saw a lower delta credit spread, either in calls or puts, it is a very high probability strategy. Now, there is a trade-off, because when you're out of the money like I am, and you are doing lower deltas, you are getting lesser of a return, but you also are taking lesser risk. So I would take that any day. I would take a slightly reduced return for a lot less risk. Routine trades, nothing is automatic routine. Every situation is different. We do set up regular, the regular schedule trades, staggered, laddered, whatever you want to call them. We've explained how we do that using multiple trades, using the same vehicle with various expirations. You get, according to how far out you go, different premiums. Sometimes you get bigger premiums shorter in if you can exploit that volatility that you get during the day. The best trades occur outside of the Bollinger Bands or underneath the major moving averages. And again, we aim for 90% probability or better on our outcomes. And we've been really, really consistently good at doing that. How to find the low delta trades. Find a chart with a nice price movement. We've named several. Try to find charts that have defined ranges, the SPX and the RUT. Look at the lowest I showed you. We start at the very bottom, the most attractive options in the montage. I showed you on there how to do that. Look for charts that are outside the 2 standard deviation. That would be that third Bollinger Band. Ensure that you can collect enough premium for the risk taken. We're looking for at least $2. If it's closer in, you can take a little less, but try and get as much as you can. This puts you into the high probability, low risk situation. Selling premium, you want to do it after or during. Just make sure that it's pretty much done. A surge in volatility on calls or puts, and it will, if you do it right then and there, it'll pretty much melt away, and you'll be able to see it on the chart because a candle will come down. It'll make a huge wick. That's when you want to be selling your premium, as it's just starting to make that wick, and your bull put spread or bear call spread will immediately start to melt away. Do it on a holiday, you get extra days. That premium will decay, it's just free time. The worst time to do it is when you have rising volatility or when the markets are not bid. If there's no bid in the market, they're just not going to pay you anything, and it's best just to sit it out and wait for a better opportunity, because then both calls and puts perform poorly. You sell calls and puts when they are expensive. Refer back to the RVX chart and the VIX chart that are clearly marked. You'll have access to those. Always refer back to those as to when to sell what at what time period. Now, Bob, I'm going to hand it back over to you. Thank you guys for listening to me. I hope I didn't wander too much, and it was a true pleasure to talk to you.
You did fantastic. All right, so I'm gonna wrap it up with the risk management part here. And can everybody see my screen here? Suze, can you see it?
Yes.
Okay, good. So I will get the slideshow going. So it's kind of apropos here to get started here because somebody had already asked me a question about risk management, and Glenn asked, will you ever morph a trade and buy back the option that is hurting you? And that's all about risk management. If you see that, but by the same token, as Suze mentioned earlier, 80% of all options will expire worthless. So while you find yourself in situations that you feel you're out of control, right? You have to step back a little bit and understand what the trade is all about. This is like driving your car from one destination to the other. You'd like to think you'd get there with a full tank of gas and no problems with your car, but you can always run over a nail and you get a hole in your tire and you have to step back and repair it. That doesn't necessarily mean you're not going to get to your destination. It may take you a little bit more time to do it, or maybe a little bit more effort in this particular case to get there. But the point of the matter is, if you see something happening and it's beyond your control and you don't want to take the risk any much longer of holding that position, then yes, you can cut bait and move along before something bad happens. I think we all, raise your hand if you've all remember what happened in 2008 and 2009 when it just seemed like we were going down the drain with our financial markets, right? It was only 9 years ago, but it's certainly fresh in everybody's mind, I suspect. I raise your hand. I see a lot of you raising your hand already, saying the same thing. Of course, we're always worried about that particular thing happening. We weren't even too far removed from the previous bear market. It was 8 years prior, back in 99, 2000, 2001. Or not 99, it was 2000, 2001, 2002, right? We were only 7 years removed from that. But by the time we'd already skipped up to that. So today, we're 8, 9 years removed from the financial crisis. We're always worried about risk management. We should be. And if you are, I applaud you because there's so many people out there who don't take risk management seriously. So in September 16, Susan and I started this options spread trader, explosive option spread trader product with a $100,000 portfolio, right? So we did that on purpose because we wanted to demonstrate what good risk management is all about. It's not about throwing all of our eggs in one basket. You trade 10 contracts per trade off the size of this portfolio. That is appropriate. Let's say you got a $50,000 portfolio. Trade only 3 to 5 contracts per trade. Maybe you do have a $100,000 portfolio, 10 contracts. Let's say you're in a $200,000 to $300,000 portfolio. You shouldn't really trade any more than 15 contracts. And in a $500,000 portfolio, 20 contracts per trade, because we're not only putting on one trade. Currently, Suze has 4 trades on, a couple of condors, 3 condors actually in another trade. You've got to have money available to make those other trades. You want to have there's laddering these things up, putting them on different expirations. You've got to have money available. You got to be ready to go, ready to pull the trigger on another trade. We don't want to put all of our eggs into one particular trade, one particular contract. Premium selling requires a margin account. Suze talked about that earlier. So you have to have available margin to put these trades on because you're getting a credit for these trades. And also knowing that your buying power is going to be reduced when these credit spreads are sold. We make these trades in the spread trader service, which are actually live trades. So I want to give you a little bit of word on risk. Remember something. There is no free lunch in trading. There is no free lunch. I know Jim Cramer talks a lot about the only free lunch out there is diversification. And by laddering trades, we are diversifying our trades out there as well too. But remember something, there is no free lunch in trading, and there is no risk-free trade out there. There is low risk, which is what we do, high probability trading, but there are no zero risk trades out there. There is always some headline risk that can knock you back to the Stone Age, if you so be it. Okay, headline risk that can create an adverse outcome for you. Remember a couple of a few weeks ago, the markets were up really strong. It was a Wednesday, maybe it was 3 weeks ago, and it was like the last hour and a half, it fell out of bed. And what happened? Oh, Paul Ryan, the Speaker of the House, said, well, it looks like tax reform is going to be off the table for a long time. Well, the markets didn't like it, right? Does anybody remember? Raise your hand if you remember that. The S&P 500 was up about 15 handles at that time. We closed down 10. It was a 25 handle reversal, right? So those things can happen. Those things are out there. We have to acknowledge the fact that markets have risk, okay? And risk happen. I mean, somebody, Doug Cass likes to say, risk happens fast. He's not right. He's not incorrect. It does happen quickly. You have to be able to be willing to wait out that risk, or not. You know, but we go with the high probability, low risk type of trades because we give ourselves a lot of cushion, a lot of room, just in case something falls through the cracks. This is a consistent strategy. However, it's not the most perfect strategy. As I told you, Suze's record is impeccable so far in 2017. 16 wins, 2 losses. I didn't say perfect. I said extremely good, extremely efficient, and extremely strong, but not perfect. It's not a game of perfect, folks. There are going to be some trades that don't work out in your favor. It happens. You want to just be able to put yourself in a position to win at the end of the day. And one more thing about risk management, no guarantees in trading. Again, the high probability, low risk strategy that we've demonstrated with explosive options spread trader has had absolutely amazing results with returns of nearly earning an average of 5.5% a month. Imagine adding that to your portfolio, 5.5% a month at a successful win rate of 87%. So which means you're winning almost 9 times out of 10, you're going to win. Yet, even when a trade is not working, we're quick to take it down and move on. And when we have a loss or something like that, it is quickly made up with the next 4, 5, 6 trades that hopefully are winners. So we're not resting on our laurels. We're not complacent. We're always paying attention to what's going on and keeping risk management in check. So I'm just going to run through a few more slides over here. Please hang in there with us for a little bit longer. This is your chance to get on board here. The explosive option spread trader, these are some facts. We started the service September 29th, 2016. In our first month, we booked 11 winners and 1 loss, 12 trades the first month of October. Absolute return was 12%. That's an absolute real return. That's not a relative return. And since inception, the spread trader, as I showed you in the slide earlier when I first started the presentation, is up 33%, 35.5% a month for the past 6 months. It's unheard of. Average months more than 5% on very limited risk. And again, I show you this slide again. This was something that we put together last Thursday after the close, right before Easter on 4/14. Her returns year to date were 21.15%. I think it's a little bit more than that now, Sue. It's probably close to 22.5, almost 23 year to date after this week's performance. So a little bit of why we started this service, and we identified a need for a lot of you out there. You know, we're looking for some low risk income generating strategies. We heard a lot of feedback about this, and decided to, you know, it really wasn't too hard because I mean, Suze has been successful doing her strategy for her clients and her mother for several years. So it was almost like a no-brainer, wasn't it? And thinking that, you know what, we just got to take advantage and show people what you can do, the power of low risk, high probability trading. The method that we do offers a tremendous opportunity for successful trading. Her track record is on display for all to see. She's been doing this, as I said, since extending back to 2010, so 6.5, almost 7 years worth of track record. And you see our trades as they happen in real time. We send them out via alert, text alert and email alert. Ample opportunity to get in. And so not only are our trades up 33% since the end of September, and you might say, well, okay, well, what if you don't have very many trades at all? And I get that. But 55 trades have been open since day one, since September 28th, 2016. 55 trades in just over 6 months. Averages about a 9 a month. We promise when we promise to try. We don't promise to do. We promise to try to get 6 to 8 trades a month. She's done more than that. More than 9 a month. 48 winners, and most of them have expired worthless. That's the goal, right? You want, when you sell a credit spread, you want that to go to zero or close to it. Most of them have expired worthless, because if you let them expire worthless, you keep the full profits. 7 losses, 48 winners, 7 losses, 87% win rate. So we talked about the system earlier, that and this is just a system that it works. Period. It just works. And a lot of you are in the room here. You've seen examples of this. It demonstrated really good stock selection, multiple trade opportunities each week, each month, hands-on, tactically managed portfolios that Suze puts on and mimics them with the service. Established risk management rules that work. Look, if it's not working and we talk about it and the trade isn't there, it's a bust. We're going to close it out and move on to the next trade. We trade the service with a high degree of confidence, though, not of complacency and not of arrogance, but with confidence, because it works. 55 trades open, 48 winners. That is a system that works. So far, we've produced good, strong, and consistent profits. So let me give you guys the chance here. This is how it works. We sign up. We give you instructions on what to do next. I'm going to give you guys a link in just a minute to go ahead and sign up, because this is a very, very short opportunity for you guys to sign up at the current price. You get SMS alerts available. In addition, we'll give that to you for free if you sign up for a year. Blog articles, weekly webinar invites like this one, and we give you the opportunity to earn while you learn. And this is what you get. You get 5 to 8 trade ideas a month. And again, I told you before, Suze is more than delivered on that. About an average of 9 a month. Trade ideas that are handpicked to minimize market exposure and maximize your returns. We monitor everything in real time. Real-time trade and trade updates. We sent those out earlier today, actually, explaining everybody that the Iron Condor was going to be closing at full profits by tomorrow morning. We do a weekly portfolio review, and then you get access to our deep market knowledge, market and technical analysis. So here's where you go. All right, I'm going to put this up here, put a link up here for you guys right now. It's explosive options .net, and here's the link up here right now, explosiveoptions.net/membership/spread-annual. So you can see that right there. I will put that link in the room for you guys all right now, and you should be able to see that. You can be able to get that and be able to click on that, or just copy that and put that into your browser, or just go to explosiveoptions.net and click on the trading service and go down to EO Spread Trader, and you'll see this link over here. So pretty easy to do, and I will tell you that you get an annual membership for $899. This price is going to be going up. I'm going to be putting that on the next slide as well. The first 5 people who sign up with us get a 30-minute conversation with Suze and myself, talking about anything and everything about spread trading, about options trading, about technical analysis, anything you wish. That is a great value, because Suze and I do private coaching and mentoring for people, and that is a very costly venture for anybody who wants to learn about trading. We'll give you 12 months of the SMS tech service, which is $120 value as well too. So let me ask you, let's say you're thinking right now, $899, ouch, that's a lot of money. What is it really worth it? Well, let's say you just did one credit spread, just one lot, right? and you collected, say, $130, which is very, very much doable for a low risk, high probability trade, collecting $130 for each time you did one of these low risk trades. So one contract, say a 20-point spread, you collected $1.30, you'd get $130, right? Your annual fee for this service could be paid for within about 5 to 7 trades, because let's do the math, right? Say 7 or 6 times 130 was roughly $800. Let's say 7, so 900 and something dollars. The first month, you could have it all paid for. Are you kidding me? And then all the rest of the 11 months are total profits paid for in a month with maybe only one contract at risk, right? One contract at risk. What does that mean? You could do that essentially with a $5,000 account. Okay, you could do that with a five that you can't put very many trades on. You could probably put 1, 2, maybe 3 trades on. We're not advocating putting a $5,000 account on, but you can easily pay for that service in 5 to 7 trades with as little as a $5,000 account. We're advocating having quite a bit more, maybe 15, 20, 25,000 or more. But even if you only had that much capital to work with, it's important. You could pull this off. You could certainly pull this off. Now, I said earlier that the price is going to go up, and why wouldn't it? Let's say you were managing this service, right? And you had a system that was doing as well as this is doing: 55 trades, 48 wins, 7 losses, 33% gain over 6 months, selling for $8.99. And I just told you could probably pay for the whole service in a month. Well, we'd be crazy not to raise the price on this thing. We got it out starting. We weren't sure how well it was going to. I knew Suze was going to do a fantastic job for us. I really didn't see how the excellence that was going to be done over these past 6 months. So if you decide to get in here, this is your chance. This price is going to go up. It's probably going to go up another 50%, probably close to $1,200 within the next couple of months. I promise you that. You won't see this $8.99 price for much longer. So I would highly recommend you guys get a chance to do this. $8.99 will lock you in for a year. Again, you get the full year of text and SMS messages. This will be your price going forward. Even if the price hike goes up, let's say the price goes up in July to $1,200 a year. If you lock in at $8.99, that would be your price to renew next year, even if everybody else was $1,200. So I can't tell you how proud I am of Suze and how well she's done. Everybody knows we had a great event in New York City a couple of weeks ago, and they got a chance to meet her and talk with her and break bread, and we just had a marvelous time, and they got to see the real person behind the service, and it makes a big, huge difference. Tat says the service is way more valuable than just the potential profits from the trades. If you take the opportunity to listen and to learn, do your first stuff. Absolutely, Tat. And he's been in my service for a long time, and he just started up with Suze's spread trader service not too long ago, and I don't think he's had a loser since he's been on. Arthur as well too. He's in the room. So this is your chance to get in here, okay? And we've already had a couple of people sign up. It's fantastic already. The EO Spread Trader is explosiveoptions.net/membership/spread-annual. Okay, go to that website, or else you just go to the membership page and then click on the one on the right, or I'm sorry, the one in the middle. That's her service right here, the EO Spread Trader. You guys can see that right there. Just go to explosiveoptions.net/membership and with another slash, and you'll see my picture there. I'm such a handsome guy, aren't I?
Humble too.
Marc, can I jump in here before you wind this up?
Please, Mark, go ahead.
Yeah, I ran an options department for 5 years and watched people try and put on trades like this that didn't have the tools or the discipline that Suze has really walked you through. I mean, you just saw how she puts on these trades, where she finds them. It's a lot of work, first of all, and most people don't know how to manage the trades. So this is a great income producing strategy, but only if you've got a professional who really has a disciplined methodology. And that's why I think this was such a valuable presentation for the Chaikin community. I'd like to thank Suze and Bob. If you're thinking credit spreads are for you and you're going to try and do them on your own, you're really going to run up against some big roadblocks. And I think the only way you can do it is with professionals like Suze. The performance has been good. I don't think anybody would deny that. Nobody knows what the future is going to bring. I think that's what the disclaimer was in the beginning. But certainly, if you want to generate income on a consistent basis, you need a discipline like this, and you need a professional managing the trades for you. So thank you very much to Suze and Bob. And, you know, for this price, you can subscribe and wait and see for a month if these trades actually work out the way they say they are. I mean, you've got two ways to do this. You can dive right in, which is what I'm sure Bob and Suze would tell you to do, but I'll give you the conservative way. Subscribe, watch the trades for a month. If they deliver as advertised, you've got even more confidence. So again, thank you to Bob and to Suze for a really valuable presentation. Look forward to doing it again.
Thank you very much.
Thank you, Mark.
Thank you, Mark, so much, and thank you everybody for sticking around. I know we're running kind of late here today, but I appreciate all of you guys being around, and hopefully we'll get you guys on board. And again, remember something: this price is going to go up. Mark, I mean, you know, you saw the results, right? How could we not protect the integrity of the subscribers by not, you know, raising the premium on this thing? It's going to happen, but this is their chance to get on board. So anyway, thank you all very much. Have a great day. Have a great day tomorrow. And we're going to be hitting that Visa really hard tomorrow. We got a good winner on that thing after the earnings come out. And hopefully we'll see you guys all in the chat room as well too. Suze, have a good day. And thanks for spending the time with us.
Thanks, everybody.
See you guys later. And I'll have the webinar replay up on the website a little bit later on this evening. Thanks, everyone. Take care. Bye-bye. Obviously, you see I'm sticking around a little bit. If you guys have any questions or anything, Susan and I will still here. Well, she's got to leave in a few minutes, but I'll be here to answer anything that you guys need.
I'm unable to answer any questions. Mine only goes to organizers and panelists.
Oh, you can't see. Let me go. Maybe.
I can see all the questions, but I can't answer them.
Okay, I just made you an organizer, so you should be able to open up the questions box. You should be able to see it. Yeah, Chris asked about the size of the trading room. We have about 100 people in there. 100 people in the trading in our trading room.
My questions go.
So again, the you can get here real quickly. explosiveoptions.net/membership. So hopefully some of you guys will be jumping in here.
I can't see the.
You can't see the questions. Did you?
I'm having to I see like one tiny line of.
Chris, I don't have.
Okay, now I unlocked it. Okay.
Chris, I have the trading room actually up on my other screen. Suze, are you in the trading room? You're in there right now. Is it on your monitor right now?
Yes.
You want to? Can I share your? You want to share your screen and then show that? Just Chris.
Share which screen?
Chris was wondering what the trading room looked like. The chat room.
Okay. Screen.
And John asked, how long is this price for, and will you limit the number of members so it won't affect the spread prices? That's a good question.
See it?
Chris, there you go. John, this price is going to be good. It's always good, but the offer to get a conversation with me and Suze is only going to be good until the weekend. But the price is good until we decide to raise the price, and that's going to be happening probably within a couple of months. So this is your opportunity to get in there and then talk with us for a little bit, and then get the free year of text messaging and SMS. There we go. Chris, can you see that? Chris H.
Hold on. I'm going to find a good trade for him.
Member limit. We haven't really set a limit because, John, the reason why we haven't set a limit is because the trade ideas that Suze puts out there, we're not lacking in liquidity. Okay, the RUT and the S&P 500 options have really good liquidity. Thousands of options are outstanding, so it really doesn't matter. It's not going to. The more, if we had 200 or 300 people in there, it doesn't really much matter because there's still plenty of liquidity out there to make the trades. The only problem is that, you know, people who got signed up early, it was 120 people in the service, you know, to protect the integrity of the service, you have to raise the price on it, and to protect their interest and so forth and their premium. That's what I meant.
Chris, I highlighted just one trade. I just had my own trade that I did. So it's time-stamped. This is a price line. This is separate from anything that I put in the spread trader, although it would have been an appropriate trade for the spread trader. This was a bull put spread. Earnings were scheduled or are scheduled for 5/9. I sold to open the May 5, so 4 days ahead of time this will expire. The 1690, 1670 bull put spread for $1.85 credit. I have the same one on for 428, so I actually have a price line ladder working, the same as I have a ladder for the RUT, the SPX. Lots of people do that. I'm all in green, Bob's in red. Dave calls out chat flow. So unusual options activities, he's in purple. Just, you know, lots of stuff. And it's not just stocks, you know, our options, we do stocks as well. You know, I was sharing, I have some WFC, WFM, talking about the VIX, you know, it's a total market. This is where the water cooler office, you know, where we come around to talk about what's going on through the day, and it just scrolls back to, you know, forever. And it's archived nightly. So you can go onto the website and review it if you don't have time to be there during the day, and often pick up some great trade ideas. Over here on the right, you're able to interact with any of these people by right-clicking. You can whisper to them in the room. If you whispered, it comes down here. Or you can request a private chat, and you can talk behind somebody's back. You know, discuss something private if you have, an issue, or if you have an immediate question that you need to know right then and there. You're really worried about something, or you need some advice. You hit one of us on the side, and we'll answer you. So.
And I was going to say, Philip asks, is just signing up for the trade room include the email and SMS alerts? Absolutely, actually, no.
The chat room is a totally separate service from Spread Trader.
Right, but we do have people who are in the room who are in Spread Trader, and the reason for that is because Suze does not put to protect the integrity of the service. Not everybody in the Spread Trader is in the chat room, and not everybody in the chat room is in the Spread Trader. There's not a lot of some overlap, but not a lot. So to protect the integrity of the service, she doesn't put her trade ideas all the time, or usually does not put them in the chat room. So you have to be.
There's a set of trades that go out for Spread Trader, and they only go out for Spread Trader, and they are not put into the room. But over and above what I do in Spread Trader, I put trade ideas into the chat room that are still credit spreads.
Right. So there's plenty of ideas. So I mean, that's why, I'd say the majority, Suze, I'd say the majority of people actually have both services, right? They're both in the chat room, and
they do a total access.
Yeah, they do a total access.
Yeah, most everybody does the total access so that they get the full experience, and we we really take care of our members. I mean, we actually care about them. As Bob said, we've broken bread with 90% of them. People have flown in from all over the country to attend the events that we put on twice a year. We do, personal mentoring and coaching. If you're upside down in your portfolio, you don't even know where to get started. We've been known to look at your portfolio, and review it, and
not make risk recommendations. Rather, just give you an idea. Say, what
this is where you're at, and this is where you could go.
Right. Yeah.
A
little hand holding, right?
Yeah, lots of hand holding. We're very huggy. We're a very huggy group.
but it's it's important to know. I mean, this is a good group of people. Suze is just she's a second to none. She cares so much about what she's doing and what other people are doing, and where they're headed, where their goals are. And we've all been there. We've all been at the starting line, and not really knowing where to go or how to proceed. She's been in the business for a long time. I've been in the business a long time as well too, and we're willing to share and willing to help and guide people along, so they don't hit those bumps in the road, those pitfalls that we've all done numerous times. I can't even tell you. I could write 2 books and telling you all the mistakes that I've made over and over and over again. I'm trying not to make those mistakes, but more importantly, trying to share my experiences and what I know, what I've done with all of you guys, so you don't have those mistakes, have those losses that we've experienced, right? So anyway, all right, so let's I guess we'll wrap it up. That was probably the last question, Sue. So hope you guys all enjoyed that. I hope you had a good time, and hopefully we'll see you guys signing up a little bit later on today. I see a couple of you have already signed up. I see Dawn's already signed up. Fantastic, good to have you.
Welcome, Dawn.
Welcome, Dawn, and hopefully some of these other people in the room here, like Philip, has been asking questions, and John, and we'll jump in as well too. And I recognize Michael Woods. I haven't seen you in a while, and so wish everybody a great weekend. Suze, again, thank you for staying a little bit overtime here, and I'll have this up on the website a little bit later on tonight. Thanks, everybody. Have a good week.
Have a great night.
Have a good one, everybody. And if you guys are in the chat room, bright and early tomorrow. Take care, everyone. Bye.